Bringing in Chakri Lokapriya, the Managing Director at TCG Asset Management. He's joining us right now on the show. Chakri, thanks very much for taking out the time. Everyone's talking about trying to find value in this market. Losing 700 points on the index in a single month, that's not a small amount. Is there value anywhere?
See, there are a number of things happening here. Since the budget, the issues are all local, whether it's higher taxes for FPIs or local.
Oh, sure, because the rest of the world is doing fine.
The rest of the world is doing just fine. So against this backdrop, now you have an electric vehicle, for instance, they want it by 2030. So how do you then value an auto company? So you assume that sales go down to zero by 2030, of course being replaced by electric vehicles. So which means your terminal growth rates, terminal valuations will all tend towards zero. So clearly, of course, they'll be replaced by electric vehicles. So this is the issue. So there are lots of things which are become spokes in the wheels, tightening down across the board on various sectors, which is led to a kind of what should be the fair value of the stock is. Some of it is a question.
Okay. So Chakri, the globe is holding out, India isn't. Post the Fed tomorrow, or maybe in the medium term, listen to a number of global commentaries and they express skepticism or what happened in the Eurozone area. If that were to come off, does it have a larger domino impact on India? And do you therefore reckon that the larger probability is of our markets to drifting lower or sharply going lower from where they are right now?
I think India's problems are its own creation and has less to do with global, because
but what if the globe also starts underperforming?
Because for all the talk about US and China trade deal, US is up 20% year to date, China is up 20-25% year to date, depending on which index you look at, Shenzhen, Shenzhen, etc. Exports numbers are still decently holding up for India. If you look at, still therefore we like the IT sector, we like the pharma sector. So, but that's still a very small component for India Inc. to hold up, Indian economy to hold up. So against that backdrop, I think this whole thing of infra spending by the government, if it indeed takes off, starts executing, that is important for the overall market to hold up.
Just, want to get your sense as to, while everyone's talking about the entire taxation that's scaring the FPIs, could it, also be a factor of them not seeing much incentive to stay in India with regards to earnings performance that they could get at a cheaper valuation in another country?
It's a combination of both, and importantly, taxation is a long-term issue. Of course, in India, they change it every single year, so that's a different story. So against that backdrop, when you're telling an FPI, look, we are going to take away roughly half your returns in the form of taxes, so that leaves the returns, which is far lower than even developed markets or which even other.
In the current scheme of things, is non-existent.
Non-existent. So on a non-existent, so that it makes the case even weaker to invest. On the other hand, second is the other factor, earnings are slowing down. And if you look at the current quarter, there has been, I think the earnings downgrade will be somewhere about 7%. So FY20 will end up being 7% lower. So now you'll probably let mid-teens as at best, assuming things don't get worse.
From 23 to 25%
Indeed,
earlier.
Indeed. So we'll probably, now it's probably about 13 to 15%. So there is both an earnings slowdown as well as a higher taxation, which makes the overall returns less attractive versus other markets. India has underperformed both developed markets and emerging markets over the last 6-7 months.
Okay. Now, Chakri, again, I come back to that context, though, that if indeed, let's work with an assumption that India corrects a bit because of its own doing and goes down to valuations which are optically between 15 and 16 times. And then the world market starts to unravel a bit, because at some point of time, the world markets will unravel. Does India become, because of being amongst the top 3 countries in terms of growth, become a place of safety because valuations are in your favor and there is growth? Or you don't think that because of these taxation issues and policy mismatches, etc., that will happen?
See, 2 or 3 things. If you look at currently the Nifty, if it's trading at the demonetization level of valuations,
Is it?
Yes, more or less, about 16 times.
Okay.
Because then earnings growth expectations were higher.
Sure.
Now the earnings growth expectations have moved lower. It's also trading similar to the levels of probably about 2010 or 11. Mind you, again, the difference at that point in time, earnings growth was close to single digits. And now it is still well strong into double digits. So then the whole thing hinges on whether indeed you will see an earnings recovery, because right now we're talking earnings downgrades. All managements across the board, whether it's consumer or corporate, are coming and cutting estimates. So that cycle needs to flip around. So which is unlikely to happen for the next couple of quarters. And I guess then you need some amount of policy help. You see, look at the auto industry. I mean, the CAM and other associations, they coming and saying that, look, we need government intervention to support the industry.
If it doesn't happen, Chakri, a follow-up to that, if it doesn't happen, what's your view on autos now? They've corrected quite significantly, but that doesn't mean anything. Prices can correct 50% and then correct another 50% as well, right? There's nothing to say it doesn't happen to the best of companies. What's your view here? What do you do with the auto pack now?
See, CM has cut, for instance, passenger vehicle sales for the next FY20 from +5 to -4.
Yeah.
That's a 10% swing, right? And so when a company is degrowing according to the industry, so its valuation should be less than what's worth today.
Right.
Then the only question becomes whether you will see a reacceleration. Now, reacceleration can happen only on two fronts. One is, of course, there is a government intervention and they do something about it. And second, they actually push out the EV.
They did something, but on the other side.
On the other side, right? And if you cut the GST on an electric vehicle, a vehicle which is not there, it doesn't help. And
this is like taxing the non-existing profit.
Indeed, absolutely. So on one hand, I think those are the issues. So therefore, the valuations at 18 times, Maruti is not a cheap stock if you look at the growth prospects.
Yeah, and India has been a growth market, hasn't it been?
Yeah.
I mean, you come to India for growth, not for value. Traditionally, it's been the case.
You pay the premium for growth.
You pay the premium for growth. So yeah, I think Chakri's point is well taken. I mean, maybe at 18 times too, on hindsight, Maruti might look expensive 1 year down the line. We don't know that as yet. Please don't take this as my prophecy, but I'm just saying that it may well happen.
Yeah.
Yes.
The other, obviously, point being, what does one do now when we're talking about the government push, capex spending, infra spending, a whole lot of sectors dependent around that. I'm not just talking about the likes of L&T, but you have cement to look at the other commodities, to look at steel as a sector, which is feeding into the infrastructure space. How does that play out? Because up until now, the spending was pushed back. This year actually has had a lot of wait and watches. Does that culminate into something?
I think one of the easiest things, or rather which is under the government control, is infrastructure. They're announcing and executing on road projects, etc. The infrastructure is within the government's control, so which then directly benefits all the sectors that you talked about, which is cement, EPC companies, steel companies, etc. So right now, because of elections, etc., and other well-known reasons, the order execution has come down, but it's quite doable for the government to accelerate that. So I think that's where the hope lies in the L&Ts of the world and the cement companies and the other related companies. But overall, if you look at, for instance, you mentioned steel demand is actually, domestic steel demand has weakened. Domestic steel prices have corrected. So against that backdrop, you then need this push. Now, are the valuations demanding for an L&T and EPC and cement companies? No. So from that perspective, that's where the support is for some of the sectors.
Just the valuations?
Just the valuations.
Okay, that's actually not a bad one to be in, L&T for one. And the other one, obviously, is you spoke about the safer haven names of IT and pharma, which obviously are not the big contributors to the overall growth of the economy, but are still pockets where you can seek shelter in.
Indeed.
So how long does that last, that excitement to be probably seeking safer haven investment?
If you look at the US growth, I mean, we're talking about phenomenal numbers in terms of the GDP growth, corporate earnings, etc. And so against that backdrop, BFSI spending is still very strong, which is important for Indian IT companies, and as well as manufacturing, retail are all very strong. 5G is not yet picked up all over the world, And so from that perspective, IT as a sector therefore has earnings visibility, and the earnings visibility gives you a certain amount of clarity to the PE that you can give. And the same story holds for pharma, but more pharma selectively, because pharma has individual company FDA issues.
Okay, Chakri, my final question to you really, and that is on what would you do with the mid-sized banks? You look at these companies very, very closely, and this time around we've seen a bank or more meet that growth speed breaker, which has pushed it back by anywhere between 2 quarters to 4 quarters on the earnings front, on the growth front. Now, is it risky therefore to go out and bet on the mid-sized banks because of the environment, there might be hiccups which might just push them back, which might be major speed breakers for these small banks, but just be minor hiccup for the larger banks. So therefore, because of the environment, for the time being, avoid the small banks, try and bet on the large banks. Is that a good thesis, or you don't agree?
I think that's a thesis selectively, because if you look at the large banks like ICICI have shown that they're increasing provisioning, which is a very good thing in a slowing down environment. Overall, like SBI cut rates yesterday, which shows that there's ample liquidity in the system. So when there's ample liquidity in the system, it gives a bank more wiggle room, whether it's a large bank or a mid-sized bank. Mid-sized banks have also corrected. I mean, their valuations are undemanding today. They've all done good jobs in cleaning up their book over the last 3, 4, 5 years. So from that perspective, yes, mid-size, some of the mid-size private or maybe even the PSU banks are more longer-term plays because there's more value in them. On the other hand, with the large ones like what you call ICICI or Axis, valuations are still not yet demanding. At the same time, you can see growth out there, because clearly the larger ones will continue to take market share versus the mid-sized ones.
Which brings me to an interesting anecdote with regards to the index polarization that we've seen in terms of the weightage of stocks. Top 10 weighted stocks now have been pushed to the upper end of weightages. So every time you see the top 10 stocks garnering about 59% plus weightage, that's the time that you start seeing a slight bit of a dip in those top 10 stocks, and the bottom 30 stocks starting to pick up, because there's been so much of polarization. Mutual funds have been piling up on only those 10 stocks, so the ownership also increases of these 10 stocks, and then finally you see them starting to come off and the bottom 30 picking up. Do you see that happening now? Do you see that polarization being taken to the peak?
You know, it's a self-fulfilling prophecy, because what's happening here is as the weightage of the top 10 stocks also is increasing, because, you know, as all the mutual funds and all the market participants gravitate towards those stocks just price movement moves higher, therefore the other stocks weight goes down, and therefore there's a rebalancing upwards more towards the top 10 stocks. It's a technical thing, but as the weight of the top 10 stocks keep increasing, more money has to go towards the top 10 stock. This music will stop at some point. The question is when. But until that point, I think the top 10 will continue to see increased flows.
Well, very, very insightful chat today, Chakri. Thank you so much for taking the time out and being in our studios and talking to us.
Thank you.
Thank you.
Thank you.
That's the view from Chakri Lokapriya.